I think if you're working with a small amount of money, with exactly the same background that Charlie and I have, and same ideas, same whatever ability we have, I think you can make very significant sums.
You don't need to have 6 to 7 figures to invest in dividends. You don't need $10,000. $1,000 is more than enough to start.
And I would do far better percentage-wise if I were working with small sums. There are just way more opportunities. If you're working with a small sum, you have thousands and thousands of potential opportunities.
Today, we are going to teach you how you can start your own dividend portfolio with as little as $1,000. We'll walk you through the process step by step. We'll show you the kind of stocks you need, the dangers to avoid, and all of the misconceptions in between. But make sure you stay until the end because we've covered some of Warren Buffett's greatest tips throughout this video. And remember, following in his footsteps is your free hack to a winning portfolio. If you've been following Warren Buffett for years, then you are probably already aware that he's a big fan of dividends. And why wouldn't he be? Dividend stocks are safer than growth stocks or any other kind for that matter, especially in the long run. So it ticks all of his boxes. Alas, you might want to slow your roll a little bit. Like all investments, dividend stocks are not black and white. Tiny decisions can make or break your portfolio, and that is why it is so important to have a winning strategy. But first, what exactly are dividend stocks? To put it simply, these are the shares of companies that distribute a portion of their profits to shareholders in the form of dividends. When you own shares in a dividend-paying company, you receive regular payments, typically on a quarterly basis, as a reward for investing in the company. But while the payments are usually in cash, they could also be in the form of additional shares of stock. In any case, dividends are packed with all kinds of benefits. To start with, it is the king of passive income. All you have to do is literally buy the dividend stocks, go to sleep, wake up, and at regular intervals throughout the year, boom, you get dividends. You don't even need to touch it. Secondly, dividend stocks offer mega compound returns. When you reinvest your dividends, the value of your portfolio compounds, pushing you higher and higher. Lastly, dividend portfolios tend to do so well against the nasty cons of inflation. Did you know that dividends have grown at an average rate of 4.2% since 1912? This means that it slightly outpaced the average inflation rate of around 3% during the same period. But hey, it is not exactly a bed of roses either. Investing in a dividend portfolio has its drawbacks. To start with, such a portfolio typically comprises only large-cap corporations and companies. This is because companies capable of paying dividends are usually well-established, with many falling into the category of blue-chip stocks. Consequently, diversification across various company sizes, including smaller firms with significant growth potential, is limited when focusing on dividend-paying stocks. Secondly, your returns might be limited. Following the ex-dividend date, the share price typically decreases by the amount of the dividend paid. This adjustment reflects the fact that new shareholders are not entitled to receive the dividend payment, which can impact overall investment returns. And finally, companies can cut their dividends at any time. While dividends are safe in theory, companies aren't exactly mandated to keep the flow going. Only the dividend aristocrats who have consistently paid out dividends and maintained growth over the past 25 years or so are likely to not cut their dividend. But now that we've understood the pros and cons of having a dividend portfolio, let's talk about some of the crucial components that you need to target before you begin. When starting a dividend-paying portfolio, the first thing that you need to look out for is a company that has a proven history of paying its dividends. Warren Buffett loves these companies. Till date, his dividend portfolio is filled with aristocrats that can maintain a juicy yield for several decades. Make no mistake, guys, one of the worst things that could ever happen to you is a scenario where the company you're betting on cuts its dividend. Apart from the fact that such an event will drastically diminish the expected returns of your investment, it may even be an indication that underlying financial difficulties exist within the company. So always ensure that you do your homework in this regard. To find the exact amount a company dishes out as dividends, you can search for its ticker symbol on platforms such as Yahoo Finance or Google Finance. Alternatively, if you solely seek their dividend track record, Dividend.com is a pretty reliable resource. For example, check this out. According to the site, we can see that Johnson & Johnson has a record 63 years of consecutive dividend increases. The second aspect to consider for a dividend-focused investment portfolio is assessing the dividend yields. For the uninitiated, dividend yield is a financial ratio that indicates the annual dividend income a company pays out relative to its share price. It's calculated by dividing the annual dividend per share by the current market price per share and is expressed as a percentage. Essentially, it shows how much income an investor can expect to receive from owning a particular stock in relation to its price. A higher dividend yield suggests that the stock provides a higher return on investment through dividends. For example, with AT&T's dividend yield of 6.83%, this means that for every $100 that you invest in the company's stocks, you would receive $6.83 in dividends per year. Compare that to Johnson & Johnson's 3.24%, and you'd get $3.24 for every $100. However, make sure that you don't fall into the trap of solely pursuing stocks with high dividend yields, as it could wreck your wealth. But before we tell you why, let's paint the bigger picture. The point we're trying to get across here is that instead of mindlessly looking for the highest yields available to you, analyzing your options is key. High yields are not always a good thing. In fact, Warren Buffett believes that mindlessly chasing it is stupid.
And reaching for yield is really stupid, but it's very human. I mean, and I understand it. And people say, well, I saved all this money all my life and now I can only get 1% out. What do I do? And the answer is you learn to live on 1%, unfortunately. And
companies often utilize dividends as a mean to appease disillusioned investors during stagnant stock periods. In fact, many companies have known to do this. Remember the dreadful case in 2008? The dividend yields of many stocks at the time were pushed artificially high due to the decline in stock prices. And of course, people fell for it hook, line, and sinker. As the economy and financial crisis became worse and profits further nosedived, many dividend programs were cut, sending stock prices plunging. Not even bank stocks could escape the crisis. Always remember, guys, high yields don't translate to a solid performance basis. When a company offers a substantial dividend yield, it's very likely that the firm is prioritizing distributing profits to shareholders rather than reinvesting those earnings to expand and enhance its core business operations. And as you'll soon find out, it is a big red flag. You see, the third step to Warren Buffett's dividend-winning formula is keeping a keen eye on the dividend payout ratio. It can be calculated by dividing the total dividend paid by the company's net income and then multiplying it by 100%. Let's assume a company called XYZ gets $30 million in profits annually, and then they're paying out $7 million in dividends. That's $7 million divided by $30 million, so their payout ratio is about 23.3%. As a company allocates more funds to shareholders through dividends, the amount available for reinvestment in the business decreases. This results in less capital being directed towards internal growth and instead funneled back to shareholders, potentially limiting the company's ability to expand its operations. And when that happens, their growth potential becomes stunted. So you see, when selecting a dividend stock, it's important to pay attention to their dividend payout ratio. It's one of the easiest ways to assess whether or not their dividends are sustainable in the long term. Take Coca-Cola, for instance. They always use their cash to effectively improve their operations. Finally, the fourth step that you need to take in seeking a dividend portfolio is diversification. Ideally, you can choose between 10 and 20 stocks that satisfy all of the criteria that we've already talked about. However, you might want to spread the diversification across multiple industries, as you'll be in a better position to overcome a myriad of potential challenges. It might be boring, but it's an absolute winner. The Oracle of Omaha never tips his hat in one industry, ever. In periods of economic downturns, some sectors may experience slow growth while others may thrive. And that's where diversification truly shines, because it spreads risk across different stocks and industries, reducing the impact of poor performance on any single investment. By owning a variety of dividend-paying stocks across sectors such as consumer goods, technology, healthcare, and finance, you can mitigate the risk of sector-specific downturns affecting your entire portfolio. So now that we've given you the rundown of everything you need to know about dividend stocks, let's look into how we can build our winning sample portfolio with $1,000. Let's use about 13 stocks from different sectors. We have Johnson & Johnson, Apple, Microsoft, Bank of America, Home Depot, Visa, Coca-Cola, Chevron, JP Morgan, Citigroup, PepsiCo, Occidental Petroleum, and Kroger. As you can see, we've got a well-diversified portfolio across healthcare, finance, oil and gas, financial services, beverage, technology, and retail. And the best part is that, to this very day, Warren Buffett still speaks very highly of all of them. Take Apple, for instance. With an impressive business advantage, an exceptional moat, a management with clear vision, it is arguably better than any company Warren Buffett owns. But hey, don't take our word for it. Here's the Oracle of Omaha saying so himself.
Our criteria for Apple is different than the other businesses we own. It just happens to be a better business than any we own. And we put a fair amount of money in it, but we haven't got more money in it than we've got in the railroad.
Now what we're going to do next is take our $1,000 and evenly spread them across the entire portfolio. Given that we have 13 stocks, all we need to do is divide our capital by the total number of companies, and that should give us 76.9, or approximately $77 per share or per stock that you could own. So real quick, let's briefly highlight some of the stocks that we picked for our sample dividend investing portfolio so you can really understand why they're so exciting. Let's start with Visa. Visa currently trades at $274 as the making of this video. So while it currently has a forward dividend of $2.08 with a yield of 0.76%, it also has an enticing payout ratio of 18.69%. And check this out. For 16 straight years, Visa has consistently raised its dividends. And it's not going to stop there. With debit transactions and payment volume growing as well, Visa isn't going anywhere. As a matter of fact, it's going to keep growing from strength to strength. Another stock that we'd like to talk about is Coca-Cola. After all, it's one of the Warren Buffett all-time favorite companies. Coke has one of the longest running dividends ever. For 58 years, it has been paying and increasing its dividends. Forget about it being a dividend aristocrat, because it's more than that. It's royalty. And the best part is that it's never going anywhere. It's consumed by millions across the world every season. Not even a collapse of the economy could stop it. Plus, it's kind of recession-proof. Given that everyone's going to be consuming Coke no matter how good or bad the economy is, it's safe to say that you're going to receive lots of growth holding on to this dividend stock. And when you consider the fact that it's consistent, what could be better than that? Can you see why Warren Buffett keeps winning and why he believes following his blueprints with frugal capital can set you up for long-term success? His approach emphasizes investing in high-quality, undervalued companies with strong competitive advantages and reliable dividend-paying histories. By adhering to these principles and consistently reinvesting dividends, you can harness the power of compounding to grow your wealth exponentially over time. There's no better time than now.